Good morning. Welcome to Trading Hour. I'm Reema Tendulkar with Mia Pavitra Parekh and Sonia Shenoy. Good morning, girls. I think resilience is my name, right? Wall Street has closed in the red every single session this week. It's down 2.5%. And look at the Indian market holding well above that 18,000 mark despite the tumultuous external environment.
Absolutely, right? 18,000 is holding, it's firm. It's the end of the week, by the way. So let's get our first guest on board. It's also largely the end of the earnings season. Of course, we do have big earnings, the likes of SBI coming out tomorrow. But Gautam Dugard, our first guest of the day, is joining in. He's the head of research institutional equities at Motilal Oswal. So let's get him on board. Gautam, good morning and thanks for being with us. You've written a very interesting report on the Q2 earnings and you've covered about 100 companies. Tell us a little bit about what the fine print has been. By and large, it's been a good earnings season. Banks have done well. Technology, not too bad. What are you picking up as the big themes that investors can look at?
Hi, Sonia. Good morning. Thanks for having me. So, broad theme is very simple. The numbers have been largely in line with expectations. Nifty earnings are flat on a reported basis for the 34 companies which have reported. But X of commodities, which is basically metals and oil and gas, the earnings are up 25% versus expectation of about 20%. And even for the broad coverage that we track, while on a reported basis, earnings are down about 6-7%, they're still slightly better versus our expectation of about 10-11% decline. And even for the broader segment, excluding commodities, the earnings are up about 25%. So what is doing well, as you rightly pointed out, banks and auto, which is pulling the numbers up. Consumer and IT are in line with expectations at about 15% growth for consumer and 7-8% growth for IT. So far, pharma has surprised a little bit given the beat in Sun Pharma's earnings. And metals, cement, commodities, they're all down by a big margin, which is in line with expectations again. But more importantly, the earnings revision is fairly stable. There is marginal upward revision, about 0.4, 0.5% kind of a number for both FY23 and FY24 Nifty EPS. So we are at about 820 rupees for FY23 now, and roughly 985, 990 rupees for FY24, which basically translates into a 12% earnings growth for FY23.
Gautam, morning. So on the subject of valuations, now, as your report points out, the Nifty is trading at 22 times FY23 PE, which is higher than a long period average. But there is no saying that it can't get more expensive from here on and valuations can't rise. Can you tell us, in the past cycles that you've analyzed, how high have India's valuations gone? When a lot of things are working in its favor, this 22 times can very well become 25 times. Anything that we can learn from the past cycles on valuations?
Yeah, Rima, you're right. Valuations do have some room for upside if you go by past cycles, but we must also remember that no two cycles are similar. Basically, the way to look at numbers right now on valuations is on a 12-month forward basis, Nifty is trading at 19.6 times, on a price to earnings basis, which is bang in line with its long period averages, right? The noise, however, on valuations is emanating because on a relative basis, we have done very well, whereas the global markets have struggled in the trailing 12 months. So when you look at India's valuations in the context of MSCI emerging markets, the premium now is a staggering 155%, which is at an all-time high. Because the rest of the markets have done pretty much nothing. Secondly, if you look at the trailing returns on a last 10-year basis, MSCI India has given you 11.5% kind of a CAGR for a decade, whereas MSCI emerging market has given a negative 1.5%. And the numbers are similar even on a trailing 5-year basis. So while one can always make that argument that relatively India's valuations are expensive vis-a-vis other emerging markets, but that has always been the case. On its own, on an absolute basis, Nifty is bang in line with its long period averages. The forward returns from here, as we have also mentioned in our note, will be a function of where the earnings settle. Because last 2 years, earnings have been excellent. After a 10-year of 5.5-6% kind of a CAGR from 2010 to 2021, we saw 20% growth. 2022, we saw 40% growth. And this year, we are at about 12% growth. So in 3 years, the earnings are up 80% cumulatively. Nifty's profits have gone up from 3.5 trillion to 6.6 trillion. If the expectations which are there for FY24 are met, then I think we still have some room for upside on a 12-month forward basis.
You're saying that India's valuation premium over the other emerging markets is at a record 155%. We've never
Yeah.
seen this kind of a valuation premium in the past.
Not at least in the last 15 years. But see, it is like this. While we are at about 20, 21 times on a 12-month forward basis, the rest of the markets are trading at 10 times. So, it's more a reflection of the relative outperformance. If you look at the trailing 12 months, India is flat or maybe up 2-3%. But rest of the markets are down 20-25%. So it's not as if India's absolute valuations have gone through the roof and are trading at 25, 26 times, and therefore one needs to be extremely cautious. The premium is more a reflection of what the other markets have done rather than what India per se has done on an absolute basis. That being said, one always have to be cautious given the environment that we are living in, especially on the global macro front, and with 300 bips of cumulative rate hikes in the past 4 Fed cycles. So it always pays to be cautious and keep an eye on earnings.
All right. Hi, Gautam. Good morning, and thanks for joining us. This is Pavitra. Like you were pointing out, all of the banks have, of course, done very well this quarter. Do you expect that even going forward, a bunch of the heavy lifting for the index will be, will come in from the banks? And also within the banking space, if you could break it up in terms of, what you're really seeing for the larger banks, for the mid caps, how do you expect that to trend?
So, Pavitra, financials have been a very consistent, performer in terms of earnings. If you look at just the Nifty 11 financial companies, the earnings cumulatively bottomed out in FY18 at a profit of about 45,000 crores. And now we are reaching roughly 2 lakh crores in FY23. So it's a 35% CAGR on a 5-year basis. What has changed in the last 2-3 quarters is the PSU banks, the non-SBI PSU banks, basically, that basket is also doing well on earnings. So we saw earnings of Canara, Union Bank, Bank of India, all of them have been very strong set of numbers. Our expectations for next 2 years is also very benign on financial earnings. So we are expecting a 20% growth on a higher base in FY23 for Nifty financials earnings. So we are expecting the profits to move from 2 trillion to 2.4 trillion. What is fueling this is clearly the pickup in credit growth. You can always credit part of that to the rising inflation. Second, we are also seeing margins being fairly solid in the early part of the rising interest rate regime. And third, obviously, what has consistently helped the profitability of financials in the last 4 years is a cleanup in asset quality, where the provisions are consistently going down. And now we are seeing a big benefit which is coming through in the non-private banks basket as well. So this year, 63% of incremental earnings growth in Nifty will be led by financials. In fact, for the quarter also, if you look at numbers excluding financials, there is a decline, which is coming because of commodities. So financials remain a very important cog in the wheel as far as earnings are concerned, and even valuations there are fairly okay. So there is room for upside clearly in financials.
Room for upside in financials, you can see it in the stocks as well. In your top FY23 upgrades, Gautam, you have Maruti as one of the stocks. I just had a question there. Agreed that Maruti has the tailwind of raw material costs and, they have some new launches. But you're going with the assumption that the new SUV launches will do well, A. There are also concerns about commodity inflation in Q4, which the management has alluded to. And then there is higher marketing costs, right, which could put a lid on perhaps a more margin uptick. Would that be of a concern to you?
See, Sonia, for 5 years, auto cycle has been in the downtrend. Like I mentioned, banks' profits bottomed out in FY18. Exactly the reverse happened with automobiles. The automobiles profit in Nifty peaked out in FY18. And from 30,000 crores of cumulative profits for auto sector in Nifty in FY18, they were down to just about 8,000 crores in FY22, right? After a long time, we are seeing some things falling in place for auto, which is demand being strong, supply issues at the margin easing out, and commodity prices correcting. And we have seen that the festive season has been fairly okay for four-wheelers. That being said, on a last 5-year trailing basis, earnings are still down, right? And stock is also down, rightly so, because if I remember well, Maruti peaked out at 10,000 rupees somewhere around January 2018. So this is the first quarter of a good earnings that we have seen in Maruti. if the underlying trends are anything to go by on demand and supply, we expect the momentum to continue for a few more quarters. Of course, with a cyclical sector like auto, one has to always keep an eye on multiple things, which is interest rates, because there have been rate hikes which have happened in India as well, and there are expectations of few more rate hikes going forward. So how that plays out for demand will be a very important determinant of how Maruti and some of the other discretionary stocks in the four-wheeler segments perform.
Gautam, we'll have to leave it at that. You're a busy man. Thank you very much for joining us and speaking to us. Get into a break. Up next, we'll discuss what's buzzing in the commodity space. Manisha Gupta joins in next.
Welcome back to Trading Hour on CNBC-TV18. Well, for now, the market is still very flat, but trending into the red line. The mid-cap index actually has lost quite a bit of ground. It's down about 100-odd points, and the bank Nifty is also exerting a bit of pressure. But let's take a bit of a breather from the equity markets and get to the commodity space. We're focusing on coffee today, our favorite subject. Manisha Gupta is with us. Manisha, over to you.
Well, good news for the coffee drinkers and good news for the coffee companies as well, as the raw material coffee prices have continued to decline. The Robusta coffee futures on the ICE futures have now slipped to nearly 15-month lows. The prices have been on a declining spree for the last couple of months now, and the Robusta harvest begins in Vietnam, which is the largest Robusta coffee producer in the world, and we are looking at good numbers there. The supply also is expected to pick even higher in the next month. That's what's weighing on the prices. Also, Vietnam exports for 2021-22 were the highest in 4 years, and the markets are anticipating bearish cues continuing from Vietnam. That's about Robusta, but Arabica coffee prices also fell 5% in the overnight markets. The Green Coffee Association says that the US September green coffee inventories have surged by more than 5% year-on-year basis. Also, there's a report from USDA which has put out global estimates for 2022-23, saying that the global coffee production is expected to increase by 4.7%, consumption not so much, and also for 2022-23, the global inventories are expected to surge by 6.3% as well. So more global inventories when it comes to coffee, not so much of consumption, especially from Europe, which is the highest consumer as well, and that would continue to weigh on prices.
Manisha, thank you very much for that. Get into a break. When we return, we'll put the spotlight on some stocks which are in the news.
Welcome back to Trading Hour. Let's get you some buzzing stocks now. Hero Motocorp tops our list. It's the top loser on the index today after reporting a disappointing operational performance in the quarter gone by. In fact, the revenue growth was not too bad. It was a 7% growth on the top line, but it's the margins that have resulted in a deep cut on the stock. The margins are down over 100 basis points year on year, and the company has had higher ad spends which have hit their margins, raw material costs as well. Despite a fall in raw material costs in the quarter gone by, they haven't been able to see the benefits of that this time around, and margins have slipped to 11.4%. That has dragged their profitability lower as well. The management commentary was also a bit cautious. They do believe that the global headwinds are something that could continue to keep a lid on the gains for the company, and volumes continue to be under pressure purely because there's been no real recovery in the rural markets, because of which volumes were down almost about 0.7%. So it's a tale of two cities in the two-wheeler space. On one hand, you have Hero Motocorp under pressure. On the other hand, on the flip side, Bajaj Auto is doing quite well on the back of multiple upgrades that have come in on the stock.
And you've got a busy day as well, right? TVS and Escorts both report their numbers later today. But let's put the spotlight on Ajanta Pharma. That's deeply under pressure. Ekta's here with the details.
Well, yes, definitely a multi-quarter low when it's come to the margins of Ajanta Pharma. It's coming at around 20.9%. The street was anticipating at least around 25%, and this is versus 29.7% on a year-on-year basis. Now, that impacted the profitability of the company, which was down 20% on a year-on-year basis. Now, in terms of the revenue, that was in line with estimates, so it was up around 6-odd%. The street was anticipating around a 7% growth in terms of the revenue. Now, India's sales was higher, so that was strong, up over 20%. 25%. We had Asia, which was up over 30-odd%. What led the revenue lower was the US market, which was down 5% year-on-year, and the Africa institutional business, which was down 50% on a year-on-year basis. Now, a couple of key important takeaways. The margins this quarter were impacted by factors such as a higher raw material as well as freight costs, price erosion in US generics, and preponement of certain costs. However, what could probably cushion some amount of the downside for Ajanta is that they are more confident on the second half. So they've guided for around 26% EBITDA margins in the second half. They expect Asia to grow 20%. They expect India to grow in mid-teens as well. Motilal has a buy with a target price of 1560. Incred maintains an ad with a target price of 1439. Both, however, have cut their earnings estimates.
All right, Ekta, thanks a lot for taking us through all of the details on Ajanta. But Amara Raja as well as Exide are in focus. Amara Raja is seeing a huge gain right now. So Sonia is here to take us through what's happening here and why are the battery stocks gaining.
So both battery stocks, right, Amara Raja and Exide are doing well. Now for Amara Raja, the margin improvement is really the big story. After 5 quarters, Amara Raja has returned to 13% plus margins, and that's a 140 basis points improvement compared to same time last year. So if you look at the trend, for a very long time, the margins were languishing between 10 and 11%, and now finally back above 13%. The big trigger really is the fall in lead prices for battery companies. Lead prices are down 10% on a quarter-on-quarter basis, and about 70% of their raw material costs comes from lead prices itself. So that's a big tailwind. But I was also looking at the valuations on why Exide is surging as well. Now, if you look at the valuations, there is some headroom that exists for both Amara and Exide. Both the stocks are trading at 13-14 times FY24 price to earnings. Amara is about 13.5 times and Exide is 13.8 times. Now, both are trading at the bottom end of their historical trading range. The trading range historically has been about 12 to 18 times, and now they're at the bottom end, so there is more valuation headroom, and hence the stocks are rallying. The commentary from the management was also quite positive. They say that the demand in the automotive sector is quite robust, both in aftermarket as well as the OEM segments. Exports have shown a healthy growth, especially in markets like Middle East and Southeast Asia, and the industry battery volumes have picked up because of the telecom segment driven by the 5G rollout in India. Also, the company has announced a lithium-ion battery manufacturing subsidiary, so they're getting into this space in a big way, and that is another positive trigger. Hence, the stocks are up and about.
All right, so both of those stocks charging up. Amara is up over 10%. Exide also seeing a gain of around 6% as we speak. But with that, it's time for a short break on the show. When we come back, we'll get talking about some earnings. Amit Agarwal, Group CFO of Raymond, will join us to discuss their quarterly numbers.
Welcome back. Let's invite the first corporate on the show, and that is Raymond. The company has reported an over 2-fold jump in its consolidated net profit to come in at 162 crore on a year-on-year basis on improved growth across its business segments. In fact, the company has said that they've seen buoyant domestic demand driven by strong consumer sentiment and uptick in social gatherings, celebrations with the onset of festivities. Amit Agarwal, the Group CFO of the company, is now with us on the show. Thank you very much for joining in. Could you give us a sense of how demand is, the inventory for you, how are the footfalls in the retail stores, and what's the outlook going ahead?
Season, which has been truly celebrated after a span of 2 years because of the COVID and so on. So people really went out and started to celebrate. And clearly, when we saw month of August, we saw very strong bookings coming from our dealer franchising network. And accordingly, we produced the goods. And we were very clear that this would be a very, very strong season. And the supplies happened in the month of September. And even some supplies are yet to happen for the ensuing wedding season, which is also very, very good in the November, December, then in the January, February, March. So I think we have seen very good numbers, which is very clearly reflected if you see more than 26% growth in our branded textiles, 65% plus growth in the branded apparel business. So that has led actually to a very strong performance for the second quarter. Now, if I look at the footfalls, maybe you would not have seen the footfalls exactly in the same level as you had seen in the pre-COVID. However, what is really heartening to note is that the average ticket value has moved up substantially. If I compare it to the pre-COVID levels, it has moved up by almost 25-26%. And that shows that the people who are coming to shop are truly a destined shopper. There is, and we all talk about the K-curve type recovery, K-curve recovery, and that is very well reflected when the average ticket value goes up and the footfalls are not exactly reaching to the same levels as the pre-COVID. However, for us as a business, we are seeing more, not a recovery anymore, we are looking at a growth. And that is clearly reflected by delivering the highest or the record revenue, record EBITDA numbers, record PAT numbers. And if I look at it, our numbers compared to the pre-COVID also on a consolidated basis, we have grown 15%.
All right, you've grown 15%. What I want to ask you about now is the e-commerce space, Mr. Agarwal. So if you can take us through how that is faring and what is the kind of contribution that we're seeing from this. We're just trying to understand if there has been an improvement from the pre-COVID levels as well.
Compared to the pre-COVID levels, there has been an improvement, and it is mainly for us in the apparel side. In the apparel, because the fabrics nobody goes and buys on an online basis. I think what is being actually sold is only the apparels, and we enjoy around the 12-13% of our revenues coming in. But I think what is important to note is that we have moved to the omni-channel, and that is truly helping us in order to build the revenues. The third thing, what is also important to note is that people thought that during the pandemic, there has been a significant shift to online and which would remain permanent in nature is actually not the case. We have seen the brick and mortar stores have really big relevance as people have started to come back into the brick and mortar stores, because we think as Raymond, being in the business for 97 years, that shopping is an experience, it is a therapy. You want to show the clothes, you drape on yourself and show to your family how it looks like. So we are seeing that the brick and mortar store has its relevance, and we are growing our store count as well. We have launched the ethnics, which is, we are expanding the stores for ethnics, which is gaining a lot of traction.
Okay, so how is the performance in the export markets, especially markets like US, Europe, Asia, for ring gears, drills, the bearing category? I'm asking because are there any recession concerns because of which has demand suffered, and any new customer acquisitions that you've had?
Actually, if you see in that segment, we have seen a slight sort of deferrals of orders, especially in the European customers, not so much in the US, but in the European customers, we have seen slight deferrals because of the lack of the components for them. And that is why there is a slight lack of deferrals. The other impact, you see, volume, lesser impact would be on the volume, but the rather larger impact is because some of our auto ancillary customers in Europe buy in euros. And compared to the last year, the currency has depreciated by almost 15% US dollar to euro. And that has impacted our business in terms of the revenues and obviously to an extent the profitability in that business. However, what is good to tell is that our domestic markets are doing very, very well. We have seen, so to speak, the record number of car sales in this quarter, in the October-September numbers, and that actually is helping us as we enjoy a significant market share with the domestic players, the top tier players, and that's why we are able to offset and deliver higher revenues even in the automotive segment.
When I look at your segmental performance, real estate has done very well. The real estate and the development of properties sales have accounted for 247 crore of sales versus just 81 crore a year ago. Do you think this run rate will sustain, or amidst rising interest rates, high inflation, we could see a bit of a slowdown?
As we speak today, we have sold 85% of our total launched inventory. Even in the quarter which we just completed, we have got 2 projects in Thane. The number one is the 10X project, where we sold 120 units, and on the address by GS, we sold 67 units. So that clearly reflects that in the quarter, we have been getting very strong bookings, and even the trend continues. So I am not seeing that people are shying away from buying homes as we speak. Today, I think there is a need for the people to buy the homes. And what is the value proposition? I think that is more important, that the value proposition which you provide to the people. So the kind of expanse in terms of the green, the configuration, the amenities, and the comfort which we provide to our customers for the Thane project is excellent. And the other big satisfaction for the people is about the delivery timeline. So, the first project, we are some part of that, which was supposed to deliver in December 2024, we are delivering in December 2022, which is 2 years ahead of RERA timeline. So I think that gives also a confidence that somebody who was paying a rent, living with a family, can move quickly into his apartment or her apartment. So I think we are not seeing any kind of weakness, so to speak, in terms of real estate demand.
All right, that is on the real estate demand. Amit, just one final question I'm going to try to squeeze in. Q2, your revenue growth was strong. It was at 40%. So for the full year, do you think you're on track to achieve that 12-13% kind of growth? And also, if you can take us through what the margin guidance is for the full year.
So margins, if we see in this quarter, we have delivered 16% margin, and for the first half, 15% margin. And I think we have this as a very sustainable level of margins.
Okay, thanks a lot for joining in, and have a great second half of the year. Thanks for being with us on CNBC TV18. That's Raymond. By the way, a couple of stocks, the PSU banking space is just flying away right now, so don't lose sight of that. IOB is up over 10%. Bank of Maharashtra, a lot of these banks, Central Bank of India, Bank of India, all up about 5 to 10 odd percent. Remember, UCO Bank had given us some very positive commentary just a couple of hours ago, saying that the corporate stress has reduced substantially, and UCO Bank is also a stock. Most of these have been trader favorites. It hasn't done much for investors in the last decade or so, but now there is a big trading rally that we're seeing underway.
Even yesterday, we had a chat with Bank of India, and they told us that we've seen a big pickup in credit growth. So at the beginning of the year, we were anticipating a 8 to 10% loan growth, and now as things stand, 2 quarters later, we're saying at least a 12% growth. If corporate picks up even more, then perhaps. But the bare minimum loan growth guidance for this year is 12%. So that's a pretty big jump up. And look at Karnataka Bank. Every day since its numbers, the stock is up. Today it's up 7%. For the week, it's up 35%.
Absolutely. And that was a big theme that all the experts were talking about during Diwali as well. It was a consensus trade on the upside. So let's do one thing. We'll continue that discussion on the other side. The management of Indian Bank will be joining in to discuss their quarterly numbers. Stay tuned.
Welcome back. You're still tuned into Trading Hour. There are a lot of earnings coming through, and Indian Bank is the next one we're looking at. On the back of its second quarter earnings, the bank's net interest margin improved on a year-on-year basis as well as on a sequential basis. The asset quality has also improved this time around. So to discuss the quarter gone by as well as the outlook going forward, we're joined by Shantilal Jain, who's MD and CEO of Indian Bank, on the show now. Mr. Jain, good morning and thanks a lot for joining us. This is Pavitra. The first question I want to ask you, because this number is really popping, is the slippages, which have seen quite a decline versus last quarter. It's down around 20%. Your asset quality is also improved, like I was just pointing out. So can you take us through the guidance there? Is this a trend that we can, expect to see going forward as well?
Yeah, good morning. So you see our asset quality is getting better and better. So our gross and net NPA both have come down. And you see the last quarter, the slippage was around 2,300 crore, whereas the recovery was around 3,200 crores. And as a result, our gross and net NPA has come down, which from the 2.12% net NPA to 1.5%. And going forward, what we are seeing that our SMA 1 and 2 has come down significantly, again from 0.61 to 0.5. The collection efficiency is maintaining at 95%. So going forward, we see that our asset quality should improve from here also.
Okay, asset quality should improve. Mr. Jain, we were having a chat with UCO Bank a couple of hours ago, and the management told us that for the last many years, the big issue was corporate slippages. They had a very difficult time, and now there's a huge improvement there. They don't have any major corporate account under stress. Are you seeing an improvement as well in the corporate space, and can you give us some numbers?
Yeah, in corporate side, actually, the slippage was around 200 crore in the last quarter. That is only a one account. Otherwise, we are not seeing any stress in the corporate book. Maybe 10, 20 crore, but not beyond that in a corporate side. So going forward, the stress may be from the MSME book also, but it will not be a much. So going forward, we are seeing better asset quality.
Sir, your loan growth is slightly lower than the industry. It's in mid-single digit kind of rate. What is the guidance that you have on loan growth, and where is the growth coming from for you?
So our loan growth was 14% on a YOY basis. And basically in the RAM, we are growing 13%. And you see quarter on quarter, consistently bank is posting double-digit growth in a RAM sector. And today our RAM is around 62% of our book. And all segment of the RAM are growing, whether it is a SME loan or it is a agri loan or a retail loan. In a retail also, you see our housing is growing 11%, auto is growing 28%, gold loan 19%. Like in agri also, the gold loans, SHG loan is growing 45%. So all RAM segments are growing. In a corporate, the growth is less because we are margin conscious. Wherever we are getting better risk return reward, we are going on that. So in all, bank has grown 14%, and going forward, we also see that we also grow plus minus 2% of 12%.
Okay, got that. That is on the loan growth. You've grown around 14%, and we could see similar levels going forward as well. Mr. Jain, on the net interest margin, like I said, there's been an improvement on that as well. It's at 3.2%. Can you tell us what you expect on this? We have seen it, gradually go up. So should we expect that in the coming quarters as well?
Yeah, so your net interest margin was 2.91 in FY22. It was 3.10 in first quarter, and it is 3.20 in the second quarter. Average, we are at 3.15. Going forward, the interest rates are tightening. So interest rates on deposit is also increasing. And considering all this, we are hopeful that we will be able to maintain the net interest margin of around 3% or so.
Okay, net interest margin of 3%, right, is what you said?
Yeah.
Okay, all right. And you said this loan growth will be about 10 to 14%. Is that something that you're looking at by the end of this year? And what is the target for FY24? And can you just break it up for us between retail loan growth, corporate loan growth? Where do you see the maximum, and also SME?
Yeah, basically we are growing 13% in the RAM. So that 13-14% will continue in the RAM. In a corporate side, based on the availability of margin, risk return reward to us, we will take a call. So if we are getting a better margin, we will grow 14%. If we are not getting margin, then we will be in a credit substitute or other products. So that is why I have given a guidance of 10 to 14%. But RAM, we will continue to grow 12 to 14%.
So why are the margins lower on the corporate side?
In corporate sides, basically the availability of funds, and there are various sources of raising funds in corporate sides. So there always be a pressure on the interest rates, and we too are basically on BBB, A and above rated accounts. So we are mainly concentrating on that.
Okay. You said asset quality will improve. Any guidance? Gross NPAs were at 7.3%, net NPAs were at 1.5%. What could these numbers come down to, say, in the next two quarters?
Our gross NPA should be around 7%, and net should be less than 1.5%.
Okay.
Okay, got that. The other big theme that we have been talking about is, of course, credit growth, how it's looked quite robust for the entire banking space, and it continues to pick up. Can you take us through your own outlook on that?
The credit growth is happening in the industry, and this is the best time from the bank's point of view where the credit growth is increasing. You are getting good margins. So that is why we too are focusing on the credit side, and basically we are more of a retail type of a bank where we are consistently getting margin, consistently growing.
Okay, all right. On that note, we'll let you go. Mr. Jain, thanks a lot for joining in. That's the MD and CEO of Indian Bank talking about a pickup in their business. Slippages are lower, retail growth has picked up, and the 10 to 14% range is what they're looking at in terms of loan growth. Let's take a short break. We'll get you more on the markets on the other side. Do keep it with CNBC-TV18. Welcome back to Trading Hour on CNBC-TV18. Well, for the market, just a quick look. It's absolutely flat. It hasn't done anything all day. I guess just taking a pause, as we were indicating earlier, ahead of the big events later today, which is SBI numbers tomorrow, and you have the jobs data from the US later today. But sources tell CNBC-TV18 that the government is likely to fast-track its divestment plan. Yash is joining us with all the details. Yash, what are you picking up?
Well, Sonia, the next 4 months of the financial year are going to be very crucial for government's divestment plans. What we've been given to understand from our sources is that there are 4 important offer for sale or OFS issues which the government plans to bring out and launch in the next 4 months. Which are these 4 companies? These 4 companies include names like Coal India, Hindustan Zinc, NTPC, as well as RITES. As far as the total divestment from these 4 companies, the OFS issues are concerned, it could help government raise anywhere about 18,000 to 20,000 crore rupees. Do remember, the government for the financial year has set a divestment target of about 65,000 crore rupees, out of which 24,000 crore rupees has been achieved so far. As far as these 4 companies are concerned, Coal India, the OFS is expected to be around 5,000 crore, which could give you a dilution of about 3% in government stake. In Hindustan Zinc, it's a large one of about 10,000 crore. That could lead to a dilution of about 8% of government stake. NTPC, it's about 2,500 crore with a dilution of about 1.5% in the company. And finally, RITES, 1,000 crore OFS is what we've been picking up with a dilution of up to 10% stake in the company.
Thank you very much for that. Sonia was talking about the big triggers. Tomorrow, State Bank of India is there. But apart from that, you also have Bank of Baroda. So we will get a very clear picture about the PSU banking earnings tomorrow. SBI and Bank of Baroda report numbers. It's time to get in some important previews now, which will report numbers today. So Britannia is the first one on our list. Mangalam is here to get us up to speed with the expectations. Mangalam.
Well, for Britannia this time around, more than the numbers, it'll be the commentary that will be extremely important, not only on demand, but crucially on the margins, because now we've seen some cool off in the raw material prices, but at the same time, there is offsetting cues coming in as well. While the price of palm oil have come down, wheat have increased. So all those things will be extremely important to watch out for. As far as the numbers are concerned, it's a 14% revenue growth that the street is working with this time around, a little over 4,100 odd crores, and the EBITDA grows at just around 8.5%. That would mean a margin contraction of almost 70 to 80 basis points. So just shy of that 15% mark is what the street is working with in terms of EBITDA margins. The net profit as a result of that likely to grow by about 10%, 420 crores on the bottom line is what the street is working with. The 14% revenue growth, how does that come about? 4 to 5% would be on account of volumes, and 10% would be on account of the price hikes or the shrinkages that the company is taken going forward. In fact, that is something that will aid their revenues by around 10 to 11%. Important to track the overall raw material basket, like I said, and management commentary on demand recovery, as well as what the company is doing with adjacencies, because a lot of their innovations and new products they had pushed because of the COVID, and now that things have normalized, what is their strategy out there is something we'll be watching out for too.
All right, Mangalam, thanks a lot for getting us all of the estimates for Britannia. But the big one tomorrow is from State Bank of India. So we will get second quarter numbers tomorrow. Abhishek is taking us through all of the details. Abhishek, what should we expect?
Well, Pavitra, analysts on street are anticipating the highest ever quarterly PAT or profits that SBI has ever reported. Just to alert our viewers, going into the result, the stock was around 52-week high as of yesterday. Key things to watch will be the fact that, net interest margin can improve YOY and quarter on quarter. So CLSA is anticipating a 10 basis point improvement in net interest margin on a sequential basis. Now, CLSA expects a loan growth of about 17.5% YOY and about 2% sequentially. There are two different brokerage houses with respect to slippages. So Kotak Securities has estimated a slippage of about 11,000 crore, while CLSA is expecting a slippage of 5,500 crore. So watch out for the slippage number, which could be around 5,500 crore or 11,000 crore range as per brokerage estimate. Asset quality is expected to improve. CLSA estimates a 20 basis point decline in the gross NP ratio of SBI, coming down to 3.71% when compared to 3.91% in the previous quarter. Now, management commentary with respect to growth outlook will be seen very closely. Just to alert our viewers, a couple of numbers like watch list, that is SMA 1 and 2, that is about close to 7,000 crore, and restructured book which is around 28,800 crores. How that moves will be seen closely. So our poll suggests NII growth of both 6% YOY and 6% quarter on quarter. We are working with a profit growth of 28.5% YOY YOY and about 61.5% on a sequential basis. Back to you.
Okay, thanks a lot, Abhishek, for that. Well, with that, curtains down on trading hour, but halftime report comes up next, so don't go anywhere. Do stay tuned in.